Also welcome in our friend Chris Whalen, who just popped on during that. Chris, thank you very much. And I want to talk about something that is a little bit wonky, but it's WBI, wonky but important. And you rang the alarm bell on this a few months ago on Worldwide Exchange and other programs, and that has to do with the Fed's operations and what they call the repo market. Now, please, Chris, because you're too smart, in plain English, what's happening and why do our viewers care, if they do?
Well, the Fed, for the last year, a little more, has been shrinking their balance sheet, which had the effect of shrinking banking deposits. So the market was getting tight. We saw this all of this year. We saw it in December in spades. And so there's been a lot of discussion inside the Fed for well over a year about complementing the shrinkage of the balance sheet with a program that would let them put liquidity into the market when needed. But they haven't acted on it. They're at least a year late. You know, Dudley Williams at the Fed of New York are wrong when they say they didn't miss this, or when they say they didn't miss this. So what I think it's key for investors and also the public at large is the Fed really serious about the target for Fed funds at 1 3/4 to 2? Because if they are, they got to defend that 2% upper bound. They have to be ready to add enough cash, not reserves, but cash, to make that market clear. And even today, we had a very brisk trade this morning. Yeah. They could have done more.
I guess, Josh Brown, we hear that a Federal Reserve Bank, arguably the most important, New York, has effectively a cash shortage in some ways, and it's getting fed in by the Federal Reserve macro. But we haven't seen the market move on this. Why do you think?
Because there's a completely rational explanation for why there might be a mismatch and how much liquidity is available from a Monday to a Tuesday. And I'd love to ask you, Chris, what your thoughts are. This is 6 years ago. We had something very similar, but it happened in China with Shibor, the Shanghai Interbank. And we were told that would presage a crash, not a recession, not a correction, a crash, not only for China, but for the entire Asian region and anyone that does business with China and anyone who relies on funding from anything related to China. And actually, the whole thing blew over in 2 weeks. The Chinese authorities figured out, okay, there's more liquidity needed, and there's a little bit more clarity on what the rate will be, and we'll just get all the banks to calm down. Now, that's a little bit more centrally planned than we are here. So I understand it's apples and oranges, but isn't it more reasonable to say, okay, the Fed has identified something that they are causing and they should fix it, and then we can all get on with our lives?
Well, I think that's right. But remember, when they departed and started buying trillions of dollars worth of securities, they created this super asset called reserves, excess reserves that don't have to be hedged, and they trade at par every day. So banks tended to want to hold those and not treasuries and agencies. They distorted the market. So now that we've been reducing the balance sheet, the Fed hasn't realized until today or last week that they needed to manage liquidity. When you're brutally reducing the amount of bank deposits, which is what we're talking about, every time one of those reserves got redeemed at the Fed, the Treasury had to go.
What would you prefer? What would you prefer the fix be? A standing? Yes. Here's the rate. Yes. Or stop paying so much on reserves, which frankly I think is slowing down the velocity of money. I don't know why they're paying on reserves at all.
But frankly, the Fed has to realize that they need to manage volume of liquidity versus whatever their price target is. If they say the upper bound is 2, they got to defend 2. And this morning we were trading over 2 for GCF.
They came in twice. I mean, on overnight and term.
Yeah, but this is a medium-term problem. Yeah. If they don't commit to the street before October 5th, which is their current guidance, that they're going to continue this through the end of the year, then we could repeat last December.
And that's exactly why this in the near term is important. You don't want to get into a liquidity situation. This is not going to crash the market. No. This is not going to make any asset class.
Well, Chris just said we could have a repeated December.
This is,
and I assume you mean not in a good way, like Merry Christmas.
I mean, I was talking
18% drop for the 18% drop for the Dow.
I think what Chris is indicating, and what I've been trying to emphasize, is from a liquidity standpoint. So it's not going to crush any particular global asset, but it's important because you're coming towards the end of the year. You've got a marketplace that right now everyone is characterizing it as basically having doldrums until we get to earnings. You're in a buyback blackout period, and a lot of people are reflecting back to this time last year and saying, okay, I was basically ahead about 9% in the S&P towards the end of September, and I lost my entire year. in 3 months, and I was down for the total return on the S&P a little bit less than 5%. We had a significant liquidity issue, and the Federal Reserve is better off. This is a monetary policy issue in my belief. The Federal Reserve is better off not cutting 25 basis points, but reinvesting the securities that are maturing.
And I think I want to bring it back to the equity markets because, and I think why it's important to have Chris on today is that our view, listen, the repo market, Stephanie, is confusing for people who are in the market.
Yes.
But our viewers, I think, they well know QE, quantitative easing. They know that. What they remember about quantitative easing is whether you liked it or not, it did seem to goose the markets a bit, right? Because you had sort of federal money coming in to prop things up, like it or not. This is what's happening, I think, a small form of quantitative easing. Should it goose the market again?
Well, it's an offset. Because if you're going to reduce the balance sheet, you have to manage the liquidity.
Look, I think a lot of this is technical.
But they got to buy bonds.
A lot of this is technical. A lot of this is technical. A lot of this is tax related. A lot of this is because the banks have pulled back. The Fed acted appropriately. If it's too late, okay, fine. We can debate that. But at least they acted. And there's no way they're going to stop in October. They're going to keep going. They know the market is fragile. And so that's what I think investors are looking through this, and they're looking at other things. Other things like trade, other things like upcoming earnings, and the economic data, which is very mixed.
You just scared me. I'm easily frightened, by the way. You just scared me. The market is fragile.
Well, it is.
But we know that. Uncertainty causes fragility in this market,
Look what the market did today after it sounded like Trump is getting more difficult and tough on trade. The market went south.
But it's fragile.
Same thing happened on Friday. And it's fragile because of that, and also because the economic data is very mixed. We are slowing. We're not in a recession, but it's mixed. And so we have these back and forth days of things are getting a little better, and then things are getting a little bit worse.
I want to keep it just really, really simple and basic here. And Stephanie, I 100% agree with you. And I slightly disagree with you, Chris, as it relates to the Fed right now, because I think they are giving the market the signal that, hey, guys, we have this tool. We're willing to use it. We are using it right now. And guess what? We're going to be here in the event that you need us. And candidly, again, the Fed came in twice. You got overnights. You got terms. You have them looking at how are they supposed to manage the money market liquidity on the short end of the curve right now. They can't estimate what that's going to look like. They can't determine what tax redemptions are going to be in money market funds and ETFs.
But the taxes are irrelevant. That's a tiny number.
But that's my point. But they still can't determine and estimate or put their finger in the sky and say, hey, this is the liquidity that's needed. What they're doing is stepping up.
Listen to the man whose office is probably inside the Federal Reserve. Michael, what do you think?
It's not. It's about 3 blocks from the Federal Reserve. I think
he bumps into him down the street.
So 2 things. One, I think that the risk from the Fed is what the Fed's going to miss. And the Fed isn't going to miss this.
No.
Okay, so they're paying
Absolutely
attention,
not.
and however they have to do it, they're under fire. They're going to get this right with this overnight liquidity. But to the fragility of the market, markets have been short-term fragile all year long. But long-term, there hadn't been anything fragile about this market. I mean, earnings haven't taken it down. Tweets haven't taken it down. China trade hasn't taken it down. This market has just continued to climb. So longer term, this is still one of the best
December.
markets.
I mean, and let's remember, we're almost basically flat a year and a half ago, though, Michael. I mean, we haven't exactly boomed in the last 2 years.
We're up 20% year to date.
Yes, but we just got back what we lost in December.
The markets aren't fragile. They're illiquid. And the Fed should have seen this all year. When we had tightness in the middle of a month, when we had tightness in the middle of June, that tells you that there's not enough cash for the market to clear. And
it
when
was
you
a
saw
temporary illiquidity.
No.
I mean, it was addressed in the month.
August is supposed to be a snoozer. And we had tightness in the second and third week.
They should have seen it coming. I agree with that.
And this goes back a long way.
Chris, is there, and I'm going to throw something out there, and you could say, Brian, you're spectacularly wrong. This happened after the Aramco fires. People I talked to that are in this market said actually the Saudis had to take out so much money because they need to start rebuilding immediately, and that was actually kind of not just the tax selling, that there was basically a cash crunch because the Saudis were like, we need, whatever the number is, $100 billion now
There's
of
been
our
a
money
cash
back.
crunch for the last 2 years.
Yeah.
That's why the price of the U.S. dollar.
But I'm just saying, goes to show how these second and third derivative things can rattle these markets that we didn't think about before 2007.
But you're missing it, though. But what's happening, though, is we have a solution. We have the Fed coming in. You can say they missed it, but ultimately what it's giving and what it should give the markets is a bit of solace and a bit of ease, right? Because they're saying, the Fed is saying, we are here, to stay.
Because the security guard was sleeping in 07. So what you're saying now, Courtney, is that we've got a couple security guards.
I have a bit of faith.
And they're awake.
Absolutely.
They're
They're
well caffeinated.
wide awake right now.
Well, we
wide
hope so.
awake, well caffeinated. John Nigerian in his tweets, they are ready to go.
It's what they're
There you
not
go.
watching that could be dangerous. This they're watching.
But you
Absolutely.
got to realize there's a basic conflict between the way they manage and supervise banks and monetary policy.
Yes.
And until we get people in a room in Washington and close the door and fix this, we have the top 5 banks are islands. The regulators have told them, cut off your biggest customers at year end to prove to us how liquid you are. I mean, how is this helpful?
Are they good? So I know that we've talked. I know other. Josh loves J.P. Morgan Chase. I know others around the table.
Yeah, but Jamie's out.
Okay, no, but is there any risk to the big banks from this?
No.
Okay.
No, there's not a risk to the big banks. I think what Chris is doing a great job doing is emphasizing that you're exacerbating the problem because of the calendar. You're coming up towards the end of the year, which in the last few years historically looks like liquidity, for whatever the reason might be, dries up at the end of the year. So concurrent with that, you have to address it. Secondarily, Brian, you hit on it exactly. The president keeps complaining about the U.S. dollar moving higher and higher. The Federal Reserve can't fix that with 25 basis points lower. That's not going to work anymore. The world is short the U.S. dollar. There's not enough dollars out there.
What does that mean for equities?
What that means for equities is that you are going to continue to have pressure on the global multinational companies who are not benefiting from a lower U.S. dollar until we can reverse that problem. That problem can be reversed, but it has to be reversed in unconventional monetary policy.
Which is what?
Bigger is better. Make sure the market has plenty of funding going through year end, because we're all closing our books Thanksgiving, as with last year.
Yeah.
The big banks do not want to take any incremental risk. They're done. So the mid-sized and smaller banks are still providing cash to the money markets, and they like to do it. It's a good way to pick up yield. But the point is that the big guys have said, no, we're done for the year, and it's September. So this is a pretty clear...
Well, listen.
It's very different. It's very different, though. It's very different having Jerome Powell running the Fed. And granted, he's not involved in every regulatory or technical discussion, but just having that leadership, and he comes from the private sector. He's been with private equity firms. He understands the workings of money stopping and starting and what that can do to the economy, arguably better than any of the academics who had held that position prior. Don't you feel as though the market's got a certain higher degree of confidence as a result of Powell being there, as opposed to somebody who spent 15 years in a law library at Yale?
I totally agree. I think we need more people on the Fed board who have actual market experience, not economists who segued into management positions.
Is this your audition?
Well, I worked at the Fed in New York. I'd be happy to go back. But you need people who could walk into the trading room like a Jerry Corrigan or a Paul Volcker and ask real questions.
But what I do think about this Fed, right, and whether it's at the New York Fed or otherwise, they are engaging the marketplace a little bit more, right? And I think more so than we've ever seen before, hence why I think we have averted a number of things that could have led us into a spiraling downturn.
Absolutely.
And so
they totally pivoted from just last December. Totally pivoted. Maybe they might not have cut rates fast enough or fast that as many people wanted, but they still pivoted big time. They went from tight to much, much looser policy.
Bottom line is our viewers who maybe just buy ETFs, right? They can feel comforted that the security guard is awake.
Well, there's a question on ETFs too right now and liquidity. Don't get in that game either.
No,
that's not the takeaway.
Courtney said he was well caffeinated. Actually, disagree.
He's well caffeinated, but that doesn't mean
either.
Exactly.
Either way,
he's the first to die. Remember that? What are you doing here? Okay.
Look, for the viewers,
this is not a market for the faint of heart.
Sitting and listening to this conversation, and they're trying to understand in equities why Netflix on a daily basis continues to bleed. It is basically
we have a segment
$25 above its December 2018 low. Why the fangs cannot break out, and why growth peaked in July. Those are the three equity stories for the viewers.
But Joe, you know that's literally our D block.
Right.
That's a segment coming up in this hour.
So you own a diversified portfolio of stocks, blue chip, dividends, and dividend growth, especially with the 10-year where it is. It's not.
By the way, we got to thank Chris. Does anybody here remember the great but underrated 1984 Emilio Estevez movie Repo Man?
Yes.
If they ever remake it, it's going to be Chris Whalen. He's the repo man.
I want to go repossess aircraft. That's fun.
By the way, if things keep rattling, let us know,
I
Chris
don't think
Whalen.
it was
Great analysis. You took a complex thing. It's an important one and made it understandable. Thank you very much. All right. We will move on to Netflix and other things. Here's what's coming up.